Same $10,000. Same 3 index funds. One version pays you $2,048 every single month for the rest of your life. The other version turns into almost $700,000 and pays you $98 a month. Same money, same funds, completely different life. I'm going to show you exactly how both get built. I'm Tony, and today we're breaking down a decision a lot of people are quietly wrestling with. My friend Marcus had $10,000 sitting in cash and one question on his mind. What's the smartest way to put that into Fidelity's best index funds? Marcus isn't trying to get rich overnight, and he isn't trying to gamble either. He just wants his money to actually work for him. So he looked at every index fund Fidelity offers, and he kept coming back to the same 3. One for income, one for growth, one for everything outside the United States. By the end of this video, I'll walk you through both ways to build this portfolio, the version that pays him every month for life, and the version that turns into a much bigger account. And the difference between the two isn't what you'd expect. But before we get to those 2 portfolios, we need to talk about the 3 funds themselves, because if you get their roles wrong, it doesn't matter how you weight them. The first fund is FDVV, the Fidelity High Dividend ETF. This is the one built to pay Marcus. It tracks large and mid-cap US companies that pay high dividends and are expected to keep growing those dividends over time. The top holdings are names you already know: Nvidia, Apple, Microsoft, Broadcom. And if you're thinking those don't sound like dividend stocks, that's a fair reaction. Most people picture dividend funds as boring utility companies and old-school energy stocks. But here's what's actually happening. These tech giants got so big that even a small percentage of their profits comes out to massive dividend payouts. Apple alone paid out over $15 billion in dividends last year. So FDVV isn't chasing yield from sleepy companies. It's holding some of the biggest, most profitable businesses in the world, and right now, those businesses are paying real income back to shareholders. Quick note on what a dividend actually is, in case you're newer to this. A dividend is a slice of a company's profit that gets paid back to shareholders, usually every 3 months. The more shares you own, the bigger the check. That's the whole idea. FDVV runs at nearly a 3% dividend yield, with a dividend growth rate of almost 11% and an annual share price appreciation of over 9%. That combination is what makes it the income engine of this portfolio. So that's job number 1 handled. Income is covered. Now Marcus needs growth. The second fund is FNCMX, the Fidelity NASDAQ Composite Index Fund. This one is built to grow the account as fast as possible. It tracks the entire NASDAQ composite, around 3,000 companies heavily weighted toward technology and innovation. Quick context, because this trips a lot of people up. The NASDAQ isn't a fund or a company. It's a stock exchange. Most of the biggest tech companies in the world list their stock there, which is why a fund tracking the NASDAQ ends up so tech-heavy. The top holdings are Apple, Microsoft, Nvidia, Amazon, Meta. Some of the same names as FDVV, but at very different weights. FDVV picks them for their dividends, FNCMX picks them for their growth, and you can see that in the tech holdings, which sit around 50% of the fund. The numbers tell that story clearly. FNCMX pays almost nothing in dividends, under 0.5%, but it makes up for it by growing its share price at over 17% a year. That 17% growth is the highest of any of the 3 funds in this video. So now Marcus has income covered and growth covered. But everything so far is American, and a good portfolio needs more than that. The third fund is FTIHX, the Fidelity Total International Index Fund. This is the one that gives Marcus exposure to everything outside the United States. It tracks over 5,000 stocks across developed and emerging markets. Basically, the entire world that isn't America. Quick context. Developed markets are countries like Japan, the UK, Germany. Emerging markets are countries like India, China, Brazil. Economies that are still growing into their full size. The top holdings here aren't household names for most American investors. Companies like Taiwan Semiconductor, Nestle, Novo Nordisk, ASML. And honestly, Marcus almost skipped this fund entirely. International stocks have underperformed US stocks for over a decade. So why buy something that's been losing the comparison? Simple. Because every portfolio needs something that doesn't depend on America. If the US has a bad decade, this is the fund that holds the floor. And here's something that doesn't show up at first glance. FTIHX runs at a 2.5% dividend yield, roughly a 6% annual share price appreciation, and a massive 5-year dividend growth rate of nearly 17%. That near 17% growth is higher than either of the other two funds. The international fund that nobody talks about has the fastest growing dividend of the three. So now we have our three funds: income, growth, and the rest of the world. But here's the part most people miss. Picking the funds isn't actually the whole decision. One of the most important parts of building this portfolio is how much weight you give each fund, because these same three funds can be built two completely different ways. Tilt the weights one direction and the portfolio pays you every single month. Tilt them the other direction, and the account grows into something much bigger. Same $10,000, same three funds. The weights are the strategy. For Marcus, this wasn't just a math exercise. He's thinking about retirement, and he's torn between two things a lot of us want at the same time: a bigger number in the account and actual cash hitting his bank account every month, no matter what the market's doing. So he decided to build both versions and see, side by side, what he'd actually be choosing between. Let's start with the version built to pay him. This is the dividend-tilted portfolio, and the weights look like this. 50% goes into FTIHX, the international fund, 30% goes into FDVV, the dividend fund, and 20% goes into FNCMX, the growth fund. Now, if your first reaction is, wait a minute, why is the international fund the biggest slice of an income portfolio? That's a fair question. Here's the answer. FTIHX has the highest dividend growth rate of the three at nearly 17%. Over time, that's the engine that compounds the income the fastest. FDVV gets 30% because that's where the immediate yield comes from, the cash hitting the account today. And FNCMX only gets 20% because this portfolio isn't built to grow the account quickly. It's built to pay Marcus. Here, FNCMX becomes the small growth anchor that keeps the account from stalling. And here's the part that flips the framing. Even with 50% in international, the US side of the portfolio still adds up to 50% once you combine FDVV and FNCMX. So this isn't Marcus abandoning America. It's Marcus splitting the portfolio evenly between the US and everywhere else, while letting the international fund do the heavy dividend lifting. Put those three weights together, and the dividend-tilted portfolio comes out to over a 2% blended yield, a solid 13% blended dividend growth rate, and over 9% annual appreciation. Quick note on what blended means. It's just the average of the three funds, once you factor in how much of each Marcus actually owns. Here's how that plays out over time. After year one, the $10,000 would be worth $11,134. Modest, nothing dramatic. After 10 years, projections show it growing to $30,453. After 20 years, $103,773. And by year 30, the portfolio is projected to reach $416,613. But the account size isn't actually the headline here. The headline is what that account would be paying Marcus. In year 30, the dividend-tilted portfolio is projected to pay $2,048 every single month for the rest of his life. That's $24,577 a year, hitting his account whether the market is up, down, or sideways. Of the $406,613, the portfolio would add on top of the original $10,000, $255,067 would come from capital appreciation, share prices simply going up over time. The other $151,546 would come from dividend reinvestment. Quick context on reinvestment. When dividends get paid out, instead of taking the cash, Marcus uses that money to buy more shares of the same fund. Those new shares pay their own dividends, which buy more shares, which pay more dividends. Over 30 years, that snowball gets enormous. Almost 37% of Marcus's projected growth in this portfolio would come from dividends compounding on themselves. That's not a small number. That's nearly 4 out of every $10 of growth being generated by the income side of the portfolio. Now, think about the flip side for a second. If Marcus had built this portfolio the opposite way, almost no dividend income, mostly growth, and then needed real cash flow in retirement, he'd be in a very different position. He wouldn't have a check showing up every month. He'd have to sell shares to create one, and selling shares to live on, especially early in retirement, comes with its own risk. We'll come back to exactly why that matters in a few minutes, because it's the single biggest thing people overlook when they compare these two portfolios. But Marcus had another question. What if he didn't care about a monthly check at all? What if he just wanted the biggest possible account at the end? So he took those same exact 3 funds and weighted them in the opposite direction. The weights flip almost completely. 70% now goes into FNCMX, the growth fund, 20% goes into FDVV, and only 10% stays in FTIHX. The reasoning shifts here. FNCMX gets 70% because its 17% appreciation is the highest of the 3 by a wide margin. This portfolio rides that growth as hard as possible. FDVV drops to 20% because in a growth-tilted portfolio, dividends aren't the priority. It's just enough to keep some income in the picture without slowing the account down, and FTIHX drops to 10%. International diversification still matters, but at this weight, it's a hedge, not a core position. With these new weightings, the growth-tilted portfolio runs at just over a 1% blended yield, an almost 9% blended dividend growth rate, and nearly 15% annual appreciation. And in this portfolio, that almost 15% is what does almost all the work. So if the goal is a bigger account, here's what it looks like. After year 1, the portfolio would be worth $11,582, almost identical to the dividend version. After 10 years, projections show it growing to $42,454. The gap is starting to open. After 20 years, $173,989. And by year 30, the portfolio is projected to reach $699,558. Here's where this portfolio is obviously different. Of the $689,558 the portfolio would add, $675,422 would come from capital appreciation, while only $14,136 would come from dividend reinvestment. That means almost 98% of Marcus's projected growth in this portfolio comes from share prices going up, not from dividends, not from reinvestment, just appreciation. There's a reason for that. When the funds in a portfolio don't pay much in dividends, there's nothing to reinvest. The whole engine becomes share price growth. And that's bigger, but it's a different kind of money. It's money on paper, not money in your pocket, which is exactly what shows up in the monthly income number. By year 30, the growth-tilted portfolio is projected to pay $98 a month. For the entire year, that's $1,179 in dividend income. That's the trade. Bigger account, much smaller check. So now both portfolios are sitting side by side, same 3 funds in both, same $10,000 going in. 30 years on the clock. The dividend-tilted portfolio is projected to reach $416,613, paying $2,048 a month. The growth-tilted portfolio is projected to climb to $699,558, paying $98 a month. The bigger account pays 21 times less than the smaller one. Now, some of you are doing the math right now and thinking, hold on, $699,558 with a 4% safe withdrawal is $27,982 a year. That's $2,332 a month. That actually beats the dividend portfolio's $2,048. So isn't the growth portfolio still the better income play? I'll answer that right now. First, quick context. The 4% rule is a guideline that says you can safely pull about 4% of your portfolio out each year in retirement without running out of money. On paper, that math works. But here's what changes in practice. With the dividend portfolio, Marcus doesn't sell anything. The $2,048 a month comes from dividends being paid out. The account stays whole. The shares stay invested. The dividends keep paying him indefinitely. With the growth portfolio, every withdrawal eats into the account. He's selling shares to pay himself. And if the market drops the year he retires, he's selling shares at a loss just to live on. That's called sequence of returns risk. And it's one of the biggest reasons retirees with bigger accounts can still run into trouble. Neither portfolio is wrong here. They're two different bets on what you want your money to actually do for you. Now here's something almost nobody brings up when they talk about a number like $2,048 a month 30 years from now, and I think it matters more than anything else we've covered. That number is in future dollars. It doesn't account for inflation. Prices have historically risen by around 3% a year in the US. If that holds roughly true over the next 30 years, $2,048 a month wouldn't buy what $2,048 buys today. In today's purchasing power, it would land closer to $840 a month. Still real money, still showing up every single month for the rest of Marcus's life. But it's not the same as looking at that number today and thinking, that's exactly what my life will feel like. This doesn't break the strategy. It just means the honest way to think about this portfolio is in terms of what it protects you from. A market crash, a bad year, being forced to sell at the worst possible time, not in terms of the raw number 30 years out. There's also something this comparison doesn't show on the surface, and it's worth knowing before you build either version. If either portfolio sits in a regular taxable account, not a retirement account like an IRA or a 401k, those dividends get taxed every single year, even the ones Marcus reinvests instead of spending. The growth portfolio doesn't have that problem in the same way, because capital gains generally aren't taxed until shares actually get sold. That's part of why some serious long-term investors lean toward growth and total return instead of dividends, purely on the math. But plenty of retirees still choose the dividend route anyway, and it's not because the math is better. It's because they don't want to be making selling decisions every month to fund their life. Getting a check that shows up on its own, regardless of what the market did that week, is worth something that doesn't show up in a spreadsheet. So, which one is right for you? Honestly, it might be neither of these exactly. Marcus built the extremes here on purpose, all the way toward income and all the way toward growth, so the difference would be obvious. But there's a version in between these two that a lot of